Hey, ladies and gentlemen, Steve Ferguson here, your modern mortgage loan advisor. Thanks so much for tuning in today. Today, we are going to talk about how to boost your credit scores in preparation for buying a home. But before I get started, do me a favor, like or subscribe to this channel. Let me know what videos you want me to make and what you want to see, what you guys have questions about. I want to make sure I put that out on my YouTube channel so that way you guys can have your questions answered. All right, well, let's get started. So first of all, let's get rid of some misnomers here. A lot of people think you need to have excellent credit to get a home loan, and that's simply not true. So let me give you some parameters here because you may be able to qualify right now as you sit, but if for some reason you don't after you hear this information, I'm going to teach you ways to quickly boost your scores to get ready to buy that home. All right, so first of all, there's lots of different standardized products, FHA, VA, USDA, conventional, etc., and they all have different credit score requirements. Now, what most people don't know is that you can actually get a home loan without a credit score. So even if you haven't established credit, you've never built any credit in any way, form, or fashion, you can still get a home mortgage. We just document it a different way. So keep that in mind as we continue to move forward. Now, let's say you do have credit scores, okay? Now, credit scores range from a 350 to an 850. It's funny, I talk to clients all the time who say scores outside of these numbers, but the true number is the lowest you can get to 350, the highest you can get is an 850. Now, you can get a mortgage loan with a credit score as low as a 500 credit score, as it sits right now. Once you go below that, additional credit work would need to be done in order to get you qualified for a mortgage. There are programs, again, that don't technically have minimum credit scores. VA is one of those programs, but I want to teach you guys products that generally work very well. And when you try to get below that 500 score, it's very, very difficult to get those loans. So let's stay within normal parameters, okay? Now, let's argue for a second that you've got a 500 credit score. You want to boost your scores and you want to qualify for the most programs you possibly can. So you should set a score requirement somewhere in the mid 600 range. And the reason this is important is because when you're wanting like down payment assistance or you're wanting to qualify for a conventional loan or additional loan products, they usually start between a 620 and a 640 credit score. All right. So that's kind of your initial goal is how do I get from A, low 500s to that B, low 600 credit score range. And I'm going to give you some strategies to do that, starting with your credit cards. Now, I'm going to get to your credit cards here in a second, but I want to explain a couple of different things. If you guys get credit card statements in the mail and you've got a credit score that's listed on that credit card statement, that is a different score than what we as mortgage lenders will pull on your credit. And the reason for that is they're going to use a different scoring model, okay? There's lots of scoring models that exist out there today. The one that we care most about is called an RMCR, which is a residential mortgage credit report. And only mortgage lenders tend to pull that scoring model. So that's important to understand. So like if you're using a credit card statement or Credit Karma or any of those things, you're online searching for your credit score and you don't pay for that score, chances are they're using a Score 8 or similar model. And that score, generally speaking, is about 30 points lower than your actual score. Now that's not true all the time. And so I would just say that it's the majority of the time, more often than not, it usually is that way, but I've seen them come in higher. I've seen them come in the same score. Just keep in mind, when you pull a credit report for your mortgage loan, it's going to look different than what you have for those other products. Okay. So that's number one. Remember that. So the best thing that I can recommend to you is if you're working with Credit Karma or these other programs is subtract 30 points from that score. And that's about where you are. Then you're safe. Okay. Now, let's start with some ways and strategies to really boost your credit score. So the first thing I want to talk about is your credit cards. Credit cards make it super easy to buy stuff. I totally get it. You're out shopping, you can pull that card out and it feels the free money until you have to go pay that bill. And then you only have to pay a minimum payment. Unfortunately, that impacts your credit scores. So let's talk about the parameters of revolving credit. The way that the scoring models work right now, and again, these are closely guarded secrets of the credit agency, so they're not going to tell you any of this information black and white. This is information that I've learned over 24 years in the business, working with Fair Credit Report Act certified individuals and customers and clients, and then working with some great credit restoration personnel who have helped me understand this in the business. So on your credit cards, if you owe more than a third of your limit, so if your limit's $300 and you owe more than $100, that can start to negatively impact your credit scores. And I know you're thinking, well, I have this limit. Why can't I use it? Because the credit agencies believe that the closer you get to your limit, the more likely you are to default. So they create risk models associated with those things. So for example, if you owe more than 50% of your limit, now your score starts to drop. If you get to your limit, it drastically impacts your credit scores. And if you exceed your limit, it essentially impacts your scores like a 30-day mortgage late. It's a substantial hit to your credit scores. So the first thing that I highly recommend that you guys do is work on your revolving credit and get those lines paid down to a third of your limit. Start with the smallest one, whatever that account happens to be, get it below a third, put it in your drawer. Go to the next one, pay it down below a third, put it in your drawer. And then once you get situated and everything's where it needs to be, start using those cards for gas or whatever you need to do it for. But always, every single time a payment comes out, pay it down at least below a third. And again, from a financial standpoint, I always recommend paying it off because you're paying interest. So that food that you just paid for, it actually costs you a lot more money over time if you let it be financed. But just for a score purpose, paying it down below a third is drastically going to help your individual credit scores. Now, let's talk about the second thing, longevity of credit. So if you're brand new to credit and you just opened a couple of accounts with a couple of credit cards, unfortunately, there's not a lot to rate. So you can't always get super high credit scores when you're brand new to credit in general. Even if you paid everything on time, the balances are low, etc., there's an artificial cap. And then once you get in that credit for a longer period of time, and a long period of time is usually at least 2 to 3 years, then you can get past that bump in the cap and get to your highest possible credit scores. Now, I don't want you guys to worry about getting an 850 credit score. In all the years I've been in the business, I've never seen anybody with a perfect credit score. And there's no algorithm that I can show you guys to get to that perfect credit score. So just keep in mind, if you're above a 740 credit score or higher, you qualify for pretty much any product out there that's going to be your best interest rate. So that's probably where I'd recommend you meet a goal, is at 740 or better. So longevity of credit. Now, another technique that you can use, and again, you need to speak to a financial advisor. I'm always a big fan of that. I've got some great financial advisors if you need that recommendation. Another way to immediately boost credit scores is to get added as an authorized user on somebody's credit card account that has had that account for a very long time. So say, for example, your parents, and they're willing to add you to it, then you're going to get the benefit of their credit. So now it also gives you the ability to authorize and use that credit card, but it's going to report on your credit report and give you the benefit of their longevity and their pay history. Now, you don't want to get added to somebody's credit if they haven't been paying on time, if they've really maxed out their cards, then you're really going to damage your credit that way. So I highly don't recommend that. But for a short-term boost, getting added as an authorized user certainly can help. Now, every situation is different. That doesn't work across the board, but it's something to think about. So don't base all of your credit decisions on an authorized user account, because if all you have is authorized user accounts, it's not going to benefit you anyway. It's just an extra added bonus that can boost your score a little bit when you're preparing for a home loan. Installment loans. Let's talk about those for a second. So an installment loan is like a car, a motorcycle, an RV, something that has a defined start and a defined end. Whereas a revolving card, like a credit card, what can go on indefinitely, as long as you don't let it go delinquent and everything. An installment loan has a defined start and finish. So let's say you have a car loan. If you just open that car loan, it's going to negatively impact your score in the immediate future, usually 60 to 90 days. And that's because you've opened new credit. The credit bureaus are looking at the fact that you opened new credit, and that affects your total debt to income ratios. So debt to income ratio means I make $3,000 a month. My debt is $1,500 a month, which is half. That means I have a 50% debt to income ratio. That means my debt is 50% of my income. So when you open new accounts on your credit, or if you charge money on your credit card, then that increases your debt to your income level, which can decrease your credit scores. I hope that makes sense. So it's really important to watch how much debt you have and that it maintains stability. That will benefit you in regards to your credit scoring. However, if you open a brand new car loan, you just got a car 2 months ago, you're like, man, I really want to buy a home. It's going to impact your scores for a little bit of time. As you pay that payment on time, your scores will level out. You'll probably see a little bit of a score boost because you're able to make those payments on time, and it'll be fine. Just remember, at the very beginning, it can definitely impact your credit scores. Now, the reverse is also true. If you close an installment loan, like you're getting prepared to buy a home and you want to eliminate a debt, and you're like, man, I really need to pay off this car, that can also negatively impact your credit scores. I know that sounds weird, but paying off debt can do that because it modifies the scoring algorithm. And the argument here is that if you paid off this debt, you're more likely to purchase something else, which can affect your debt to income ratios again. I know, things to think about, right? So now another important thing when you're getting a car loan or any kind of installment loan out there is the number of times that that person or company pulls your credit. Those are called inquiries. The more you pull your credit shopping for like a car, etc., the more it will impact your overall credit scores. And the reason for that is the argument states that you're pulling your credit this many times, you could open multiple lines of credit, which would increase your overall debt to income ratio, which can damage your scores. Now, the rule states that you should be able to pull your credit for up to 30 days for a house or a car, and all those inquiries only hit you one time, which is about 3 points. And then from 30 to 45 days, 10 inquiries hit you for one, and then 45 days and on, it's 1 for 1. So what that means is if you spend a lot of time shopping for something, you're pulling a bunch of credit, and then you wait for a while, your credit report expires for some reason, and you pull new credit, and all those inquiries hit at the same time, that's going to hit your credit about 3 points per inquiry. Now, keep in mind, these are not black and white numbers. These are estimated numbers because the scoring algorithms for the credit bureaus are closely guarded. I cannot tell you those exact algorithms. I can just tell you that generally speaking, this is what we generally see, okay? So inquiries are a big deal. Installment loans, if you open them or if you pay them off, balancing your credit card accounts. Let's talk about derogatory credit. If you have a collection account that went to collection recently, and when I'm saying recent, anything within the last 6 months, that's definitely going to affect your credit score. However, the overall premise is that once it's been on your credit for 6 months, it's already done the damage to your credit. It won't continue to hit your credit scores unless it constantly re-reports. Now, what's important to understand about collection accounts is that collection accounts won't just disappear. I know a lot of people think, hey, I've got a collection, I'm not going to pay it for 7 years and it'll fall off my credit. That's true, but then that company will most likely sell that collection account to another collection company and they'll re-report it on your credit as a brand new collection, and congratulations, you have it again for 7 years. And that will continue indefinitely because they want their money. So don't go along with the idea that you just don't pay it and it disappears. It's going to follow you for as long as they're going to possibly follow you. So it's better to get those things settled or paid off or do what you need to do to get them gone. Now, once they've already been on your credit for 6 months, if you call that collection company and settle on it and say, hey, look, I'm willing to offer you X number of dollars to get this thing settled and paid. If they accept that and you get it in writing, always get it in writing first, and they agree to it, you're going to have 30 days to make that payment. Once you make that payment, you've got the document in writing stating that they've agreed to these terms. So you want to maintain that document. Then they should show that as settled, as an example, on your credit report. And then once it says that, it'll disappear after it's been on there for 7 years and you never have to worry about it again. Remember, the damage has already been done within the first 6 months. So beyond that, the settlement shouldn't be an issue. No big deal to get those things taken care of. That's going to set you up for success the further you get away from it. It's the same thing for late payments on anything. If you have a late payment on a credit card, late payment on a car loan, a house loan, any of those things, the further you get away from that late payment, the better your scores are going to be. Now, one thing to consider is when you have a credit card, as an example, and I'm just going to use this as one of those things, and you had a late payment on it 2 years ago. As long as you have that credit card, that late payment's always going to show on your credit report. So there's a happy median here where it makes sense to maintain that credit. And there's another side of this where it may make sense to close that account and get something new and reestablish. It really depends on how derogatory that account is or was in the past. And so those are things that you have to look at and decide, does it make sense to close this account or not? Now, everything that I'm telling you guys is just kind of general parameters. I do not recommend you make these decisions without having a conversation with an expert. So for example, if you're wanting to get ready to buy a home, you should be reaching out to a financial advisor. Sure, if you have one, great. A mortgage loan advisor like myself, give me a call, reach out. What we'll do is review your credit and create a strategy to get you qualified. Or if you already qualify, we're going to give you that data. But you want somebody who does this every single day to look at your specific situation so that way you can make a good decision. I see a lot of people torpedo their ability to buy a home by doing things they should have never done on their credit. Don't be that person, right? Give us a call, reach out, get an expert's opinion. This is something we do all day long. And then we also know a lot of great people whose entire job in the business is helping build credit scores and get you where you want to go. And those guys are great resources to answer your questions. We can definitely plug you in with them. Well, guys, I hope this helps you. There's a lot more information out there on credit. This just gives you a quick parameter, a quick snapshot. Don't forget to like or subscribe. Drop your comments in the bottom, and I hope this helps. Hope you guys have a great day. Bye-bye.